Here we are, the fund manager is saying that duration is better than credit at this point of time, but the yields are really low. So that's one side of it. On the other hand, you have these issuances coming into the market. So there are these NCDs which come at yields of 8-9%. There are corporate FDs. One really popular one among retail investors is Hawkins Cookers, which gives around 8-9%. So Ashish, let me begin with you. Should somebody just pick one of these high quality NCDs or corporate FDs as a way of solving the inflation problem?
So, Neil, this is a very complex situation, absolutely unprecedented times. And when we talk about fixed income, when we look at a retail investor, we have to remember that fixed income is what? It is sunishtha aay, which is fixed income, right? So when we are speaking to our customers, we have to be careful about it. We have to be responsible enough that we give them information which is enough for them to decide. And therefore, what we do is DBS, being the safest, has been awarded as the safest bank for 12 years in a row. We give them a perspective that there should be a certain amount of money which should be, from a 3 to 6 months, put and parked in a fixed deposit for any emergency requirement. However, at the same time, there are enough avenues within duration, and I will not even, just now go against what the fund manager friends of ours said. I don't think it's time for credit risk. But within the duration, you still have good companies, and I don't want to name specific companies, but they are AA plus, where the yields are very good. From my perspective, I would not go on specifics in terms of going and buying one particular NCD. My recommendation to a customer, I should say, my what I would refer to a customer would be that they go long, they buy a mutual fund, which gives them a duration play, and therefore over a longer period of, and now you can't really look at it 1 year. You have to look at a little broader. You can beat the FD returns beyond a 3-year period, given the fact that a mutual fund is much more tax efficient.
There was one question submitted by a user, Ravinder Juneja, about bank perpetuals. The most common type, I believe, is 81 bonds. There was a huge issue with Yes Bank when those 81 bonds defaulted. But at the same time, they've made something of a comeback in the market. So even PSU banks issue these bonds, and people normally perceive PSU issued bonds as less risky. So Ashish, can I bring you in on this? Are bank perpetuals something for people to consider from the bigger, safer banks, could you say?
So definitely, I would say there are certain banks, especially on the PSU side, where government ownership is beyond 80%, and they are giving yields or YTMs as high as 11.25%, and therefore there are definitely opportunities, especially on the PSU bank or larger private banks.
Sorry, Ashish, could you also speak up a little?
So what I wanted to say is that definitely there's an opportunity there in the PSU bank space in the perpetual side. There are certain perpetual bonds which are giving returns as high, or YTMs as high as 11% plus, and have a government holding of 80% plus. And therefore there is definitely an opportunity there. And there are certain large private banks as well, where the returns may be a little lesser. But again, I would definitely say that is a good opportunity to be.
On a related note, there are these set of government instruments called small savings. One of them in particular I want to discuss to begin with, and then we can broaden it to others. So they are the RBI 7.1% floating rate bonds. So as the name suggests, these currently pay 7.15%, but the rate is floating, so it'll move up and down with general interest rates. And if I look at the spectrum right now, I mean, it seems to be a pretty high rate. I must confess, I went and told my mother that you invest in this. This is pretty safe. You'll get a floating rate connected to inflation. So, I mean, that aside, Can I get some views from the panel on this?
So there is a reset clause on these RBI floating rate bonds, giving you a return of something like 7.5% right now. But they get reset every 6 months. They can get reset every 6 months. Okay? And the fact that there is a lock-in of 7 years. So, it is in the hands of the investor to decide whether they are okay with time duration as long as 7 years, and have that element of certainty and uncertainty there, while credit risk, as Anurag said, is negligible. But at the same time, the uncertainty of what it can get reset to is something which the customer has to decide if the customer is okay with it.